Those are product, price, place and promotion. We completely discussed about this. Now we are in this topic. In the remaining classes, let us have a glance on place and promotion also. What is price actually? We can say that it is the amount of money demanded by a seller in exchange for giving a product or service to a buyer. Means when a seller is giving a buyer a product or service, he is going to demand money. That we can say that amount of money demanded by a seller in exchange, because he is exchanging the ownership. So from seller to buyer, ownership is transferring. So that is why seller is demanding some amount because of exchange, in exchange for giving product or service. So that's why. So product is going to consumer, money is coming to the seller. So buyer is getting the product, seller is getting money. So it is an amount of money demanded by a seller in exchange for giving product or service to a buyer. We can say in many definitions. Let us see one more thing. It is an art of translating into quantitative terms. Quantitative terms, comma, the value of the product to consumers at a point of time. It is an art of translating into quantitative terms. Means it is a physical unit having few qualities that we are converting into quantitative terms. We can say that into money. So the value of the product to consumers at a point of time. Usually, this marketing, this pricing strategies are going to be followed or handled either by the marketing department or else sales department. Whoever it may be, their final destination is achieving it, maximizing profits. That may be profit-oriented organization or non-profit organization. Any organization is required to adopt this pricing policies, because whether it may be profit-oriented or non-profit-oriented, whatever it may be, they need to sell their goods or products, means they need to adopt pricing policy or pricing strategies. Here, we are going to find distinction between price and pricing. Usually, we may think that these two are same. Price means whatever I told in this definition. Then what is pricing actually? Means in order to come to this decision of price, they need to work out on many things. They need to follow many aspects. In order to fix a particular product as price, let us take an example of, if I am selling a product P1 for the worth of 10 rupees, means in order to decide this product to a worth of 10 rupees, I need to work out. So whatever the process involved in order to decide the price is called as pricing. Usually for the product cost, a manufacturing firm is going to add profit based upon their calculations. That may be their expected rate of return, that may be on demand and supply, whatever it may be. Cost plus profit, based upon that they are going to fix selling price. This we all know. This cost is, this information is available with them. So how much they are expecting profit, whether to go for high range profits or not. Sometimes they may sacrifice few portion of profit in order to sustain in the market. So that's why they may follow different strategies in fixing the prices. So although all that process in order to come to the decision of price, that is called as pricing. In further topics, we'll discuss what are the different factors which influence the price of your product, how they are going to decide a particular product price, what are the objectives of pricing, how they are going to set a new product price, actually what are the different types of costs, because what I'm discussing, cost plus profit, that is selling price I am saying. So for that we need to make a distinction between different or various kinds of costs. So this also we'll discuss in this class. And one more thing is, among all 4 P's of marketing, this pricing is the most important one, because in all these 3 forms, on product, place, promotion, they need to incur cost. But through price mix itself, they are getting income or profit. So that's why it is the most important element. In all the 3 forms, they need to incur cost. Through price concept itself, price mix itself, they are getting income or profit. That is why it is so important in the marketing decisions. Let us know about the objectives of pricing. The foremost important thing is, every firm is going to fix a price for their product with a view or we can say that with an object of profit maximization. Few firms may adopt maintaining of customer relation or else wealth maximization, building of goodwill or image, brand, like that. But mostly their aim is going to be profit maximization. For example, if they set too high price, definitely the demand is going to fall. This we can dictate not in every situation, because if it is a very new product or very new to the world, new to the customer, new to the market, then they can rule the market also. At that time, increasing the price does not lead to decrease in the demand. So at that time, that may be right decision increasing of price, but it is not going to be favorable in all the conditions. So depends upon the situation, type of product, nature of the product, newness regarding the product to the customers, they are going to fix the price. So first one is profit maximization. In that, they are going to check whether to fix a high price or low price, moderate price based upon demand, supply, substitutes, and considering many other factors. This is one. Next one is maximization of market share. If they fix very high price to a product, definitely customers are going to opt substitute products. If a company decrease its products prices, definitely the company can capture the market. So maximization of market share is different. Profit maximization is different. If they adopt profit maximization, definitely it may not be maximization of market share in all the situations. Sometimes by fixing high price, also they can maximize the market share under few situations itself, because it is not going to be practically both the objectives are going to be correlated in few situations itself. If they would like to maximize the market share, definitely they are going to reduce the price. They are going to adopt the profit maximization, they are going to increase the price. Both are contrast situations. So maximization of market share. We cannot say that all the objectives are a single firm's pricing objectives, but overall, these are the objectives of pricing. Third one is to bring price stabilization. We can say that neither increasing or decreasing, maintaining the same price under different situations. Usually, private firms, private companies, they won't follow this price stabilization policy. They are going to adopt a pricing strategy which can be molded according to the demand and supply and different economic conditions. But this public sector undertakings usually follow this price stabilization policy. They won't increase the price based upon boom or depression. Mainly they focus for public utility. In order to prevent frequent fluctuations, they may adopt price stabilization policy. What happens if they face frequent fluctuations in the pricing policy? They cannot predict the demand. So, if the produced goods quantity is more than the demand, the producer need to sell the produce at very low price. So, in order to avoid such type of conditions, fluctuations, better to adopt this price stabilization policy. Next one is consumers' ability to pay. We may observe few firms, few organizations or companies are going to charge different rates for a similar products. How it is going to be? If you take an example of Road Transport Corporation, TSRTC, or railways. For students, they are going to charge different rates in terms of providing bus passes. Based upon the age also, railways are going to charge different ticket fares. So consumers' ability to pay, they are going to consider this ability to pay also. We can say that prices charged differ from individual to individual depending upon their ability to pay or paying capacity. One more thing is a return on investment. This return on investment and profit maximization are also interrelated. In order to achieve the target of profit maximization, first of all, at least they need a return on investment. Means required return. For example, if they are investing 10 lakh rupees in a particular business, while setting up or while mobilizing these resources, they may have an expectation of achieving 10% interest at least. So by keeping this margin, this 1 lakh rupees margin, they are going to fix the price. So in order to decide the selling price, here they are going to put that figure as this 10,000 and what is the cost. Based upon that, they are going to fix the selling price. So this return on investment also decides the pricing policy of a company. To meet competitors, they can influence the competitors by increasing or decreasing the prices. Sometimes in order to have the stagnant market position by the company, they may follow the same strategy of the marketers. If they would like to overcome or what we can say, dominate the competitors, they are going to decrease the price. Otherwise, if they are confident about their product quality, they keep on raising the product. So to meet the competitors, in order to achieve growth in sales. As we know, volume of sales depends upon price. Price depends upon demand and supply. So these are all interrelated. So based upon demand, they are going to supply, fix the price. Through that, they can increase the sales. So those are the basic objectives in order to occupy the greater market share. If they would like to lead the market based upon price leadership policy, it is important to adopt a good pricing strategy. So in order to come to a good pricing strategy, actually, it is important to know about the procedure of pricing. First of all, they need to identify the customers. Why this is required? As I told, sales, demand, supply, price, all are interrelated. And those are linked with customers. So that is why in identifying of target customers is important. After identifying the customers, they are going to decide the desired marketing position. Desired market position means whether to introduce the product or whether to sell the product throughout the geographical area or in few places or where they need to sell. So deciding the desired market position. Then they are going to analyze the price elasticity. Elasticity is nothing but what is the influence of demand of a particular product by changes in the price or any other relevant factors. So how it is going to be reacted? By increasing the price level changes, what is the impact of volume of sales? Based upon those factors, they should come to a pricing strategy. So they should analyze price elasticity. This we can analyze by dividing the products into various categories, means whether it is a durable one, non-durable one. Is it having a substitute products or not? Is it a necessary or luxury or what we can say convenient good? Which type of product? Based upon the type, nature of the product, elasticity depends. Next one is estimating the cost variables. We can say that elements of cost. What are the different costs need to be incurred? All the elements need to be studied. If you don't know the cost of these elements, you cannot come to the conclusion of price. So that's why estimating the cost variables. Based upon that only, whether we need to increase the production capacity or not, or we need to follow the same quantity to be produced in this year also like earlier. What is the increase in the price of elements of cost? Impact of this cost because of various factors in the economy. So they analyze all these factors. Next one is, this is important, that is competitors' price and offers. So analyzing competitors in terms of price and offers. Definitely they should analyze competitors' price and offers. Otherwise, we are not going to sustain in the market in the long run, because this is the major aspect in deciding the price of your product. And observing any other environmental forces are also there. Environmental forces, studying of this one is also required. Then choosing a suitable price. Afterwards, this implementation of price, they need to review this policy periodically, because many changes are going to happen in the market. They need to analyze the competitors. That may require improvement in the product, considering of the consumer's view. So by taking into consideration of all these, reviewing of this pricing is important periodically. So this is about pricing procedure. Let us come to the portion of cost concepts. Cost can be categorized into many ways based upon few aspects. The cost concepts that a marketer has to consider in the pricing decision, let us see. First one is direct cost. We can say that it is the cost which can be attributed directly to the production of the goods. Directly attributed, and it can be visible. Directly attributed. The cost which cannot be attributed directly, which is not going to play a major portion of the product, and which is not a traceable cost, then we can say that that is indirect cost. So in order to consider a cost as direct, there should be that we can directly attribute it to the product. Traceable, we can trace the cost directly, and it is going to be visible with the product. That is direct, otherwise it is indirect. One more classification is explicit and implicit. Explicit costs are nothing but producers are going to pay various costs on factors of production. What are those? Land, labor, capital, organization. So on all these factors, producer are going to incur the cost. So those are explicit costs that can be converted into monetary terms. For say, for example, 10,000 rupees as rent towards that building, 5,000 rupees towards labor, 2,000 rupees towards interest, 5,000 rupees towards profit. So we are converting into monetary terms. They are to be paid out while acquiring the inputs. So those are explicit costs. Sometimes they are not going to incur the cost, but those are required. Those costs are required. Such type of cost, we can say that implicit costs. So these are nothing but, these are the costs required for self-owned and self-employed resources. These are required for self-owned and self-employed assets. Resources. Say, for example, if an owner is full-time engagement in the business by himself, we can say that at that time, no salary is going to be paid to the owner. Otherwise, if that owner is not involved in his own business, he may, in business activities, he is going to employ another resource to look after the business transactions. So at that time, they may need to pay this amount of salary to that particular person who is looking after the activities. So for self-owned and for self-employee resources, whatever the costs which are not able to seen, those are implicit costs. These are directly visible, whatever we are paying towards land, labor, capital, organization. If any of the resources are self-owned or self-employed, we are not going to pay outside in order to get the inputs. So those are implicit costs. Next one is fixed and variable. Fixed and variable. Fixed costs are those costs that do not vary with the difference in output. So irrespective of the level of output, these costs remain constant. But whereas these are going to increase with the increase in the level of output. So variable costs are those costs which vary with the level of production. If you would like to increase the level, variable cost going to increase, otherwise decrease. But whereas it is going to be constant with the level of output, such are fixed costs. Others are variable costs. Another classification is average and marginal cost. Average cost, we all know, average costs are those costs that are incurred for total output that need to be divided with the total input. So the total cost divided by total quantity is called as average cost. Whatever the total cost they incurred, that should be divided with the total quantity produced. Then we will get this average cost. What is marginal cost? We can say that an extra cost which is incurred to produce an additional unit of product. For example, if a firm is producing 10 units, for 10 units, it requires 100 rupees. For 11th unit production, if it is producing, say, for example, 120 rupees, total cost they incurred. So we can say that in order to produce this additional 1 unit, they incurred 20 rupees. So this is marginal cost. In order to produce additional unit, whatever the additional cost incurred is called as marginal cost. What is the relationship between cost and price? We know that both are not one and same. But undoubtedly, cost determines or rules the price of your product. So based on the cost itself, we decide the price. And the extensive depends upon the demand and supply and various economic conditions. So we can say that not only the cost influences, various other factors also influences this price. So all that process in order to come to the conclusion of some amount of money in order to exchange a product, that is price, the process is called as that pricing. In order to come to a decision of fixing a price to the product, they need to go for rigorous process, various steps. By considering in various objectives, they will work out that all that process is called as pricing. While introducing the new products, they may adopt two strategies in fixing the price. First one is skimming strategy. Next one is penetrating strategy. Right. Skimming, price strategy, penetrating price strategy. What is this and what is this one? While introducing itself, if we fix high price for a product, then keep on reducing the product price. That strategy is called as skimming price. Means with the introduction in the market itself, they are charging high price, then gradually reducing. For example, if a company is having good reputation, definitely they can fix high price for that product because they are all having such brand image in the market with in the minds of customers. So they can go for high price. When competitors enters, definitely they should adopt the competitor strategies. At the time, they may go for reducing the price. So we can say that is skimming price strategy. So this method of pricing aims at high price and high profits at the early stage of selling a product and subsequently reduces the price. Under what situation? When the market situation is not favorable or unfavorable situations time, they will reduce the price. So that is called as skimming price strategy. This is reverse to the above situation. While introducing, they charge low price, gradually they will increase their price. This we can see in our daily life. When a company newly introducing a product, it is not having any other products in the market. So customers are not having any idea about that particular company. Then definitely they should adopt fixing of low price itself. When the customer is satisfied, after few years, they may keep on increasing the price. So that is penetrating price. So initially low, afterwards high. Here initially high, afterwards low. When they will adopt this penetrating price, when a product is having many number of substitutes, what is the main scope a producer is having with them, that is reducing the price itself. With this weapon only, they can capture the market because many competitors are there. If they fix the same price with the competitors, we are not going to sustain in the market. So introducing with low price, when customer is habituated to that product, satisfied with the quantity and many characteristics, then go for keep on increasing the price. If the cost of production is low, then they can go for fixing of low price. And one more important thing is, if a product nature is highly elastic, means if your price a little bit increases, the demand is going to be decreased to a great extent. Then we can say that the product is having high elastic demand. So if the nature is high elastic one, they may adopt this penetrating price. What is that? Initially low, gradually high. Just a moment. One more important topic is factors influencing the pricing decisions. We can categorize those into internal and external. Internal, external. So internal factors may be company objectives. What is the marketing mix component and organizational factors? What is the product differentiation among the competitor products? And the cost of the product. Those are internal factors which influence the pricing decision. Whether they are adopting profit maximization policy, value maximization policy, or building customer relation, or they are aimed at building a good brand image, or whatever it may be. So all those are called as internal factors, which are purely related to the firm itself. Regarding the external factors, buyers, suppliers, demand, competitors. and other economic factors also influence the pricing policy. Buyers' nature or buyers' income capacity, their mental status, social status also influences the demand. Based on the demand, supply. Supply need to be correlated with the price. So all those are interrelated factors. The suppliers are charging more price. Definitely, they also offer the products to the customers at high rate itself. The supplier is not an internal factor. He is not relevant with the firm. He is outside to the firm. So those are external to the firm. Demand in terms of customers. That is why it is an external factor. Competition, purely external. And sometimes economic conditions and also other government related factors. So tax procedures, tax rates, restrictions on exports and imports, all those relevant with the government. Economic conditions, public level of income, standard of living, subsidies, loans available in the market from the banks, all those factors are related to economic factors. So basically, factors can be categorized into internal and external. Internal means which are purely within the hands of the firm, and external means these are not within the hands of a firm, outside to the firm. Now let us see pricing under different conditions. Pricing under different conditions. Conditions means nothing but market conditions. In economics, you might have studied in your first semester itself. What are the different types of markets? That is perfect competition, imperfect. In imperfect, monopoly, duopoly, oligopoly. These markets are existing in the market. So which strategy should be adopted with perfect competition style? If it is monopoly, what need to be opted? If it is duopoly, what it is required? Oligopoly. Let us see one by one. In the perfect competition, many sellers and many buyers are going to exist. So no seller is going to dominate the market because many sellers are there. They can influence the consumers. So whatever the demand and supply is having impact on pricing, straight away they are going to adopt such type policy. Usually we can say that this is a demand curve. This is supply curve. Whatever is the intersecting point is there, that is called as price. So based on demand and supply, where it is in perfect competition, price is going to be determined. So this is first situation, means related to the perfect. What is monopoly? Usually single seller, many buyers. he is having only sole and whole person who is selling the product in the market, means he may not go for demand and supply option. He can decide on his own wish, that may be on profit maximization or goodwill within the society, improving his brand image. Based on all those, he is going to set the price in monopoly. Usually, he enjoys the right of fixing the price of goods or services because no substitutes are available. Only single seller, many buyers. So, whoever the seller is saying regarding the price, that is going to be the final price to the customers. Sorry. But whereas in duopoly, two sellers are going to exist in the market, many other buyers. Whereas in oligopoly, few sellers, many buyers. So definitely here they will follow the strategies of competitors also, because one more producer is also existing in the market. So based upon his strategy, he is going to fix the price. Whereas in oligopoly, he is going to concentrate on the differentiation in the product, because few other sellers are also existing in the market. So I would like to opt an option of differentiation in the product, increasing his brand line, his brand depth, product line and product depth, sorry. So by following all those strategies, he's going to fix the price in the oligopoly. So this is about pricing concept. In tomorrow's class, different methods of pricing. We'll discuss different methods of pricing. What are the different methods? Under which circumstances a particular method needs to be adopted? So basically, what is pricing? Definition, objectives, factors influencing the pricing, under different conditions, what is the pricing strategy need to be adopted? This we have completed. The next class, let us learn about the methods of pricing so that pricing concept is going to be covered fully. Coming two classes will be allocated for these. So the thorough portion regarding the principles of marketing. Anything doubts regarding today's class, ma'am? You can unmute yourself and you can express your doubts so that I can clarify now or else in the next class, coming class. Anyone? So that I can end the class. Shall I end the class? Okay.